All right. How are we feeling? So I know our panel already had a quick introduction, so we don't have a ton of time. I want to jump right in. But before we go straight into the topic, Adam, it's too topical. We just have to very quickly get a comment from you on the HBO documentary that aired this morning about who is Satoshi. Do you have anything to say about it? Any thoughts on it?
Well, having finished watching it, I started watching a bit of it, and I think it covers a lot more than just, speculation about who Satoshi is, which is good for a general audience to kind of bring more people into Bitcoin, and maybe there'll be more people at conferences like this next year as a result. And yeah, I think we will basically never know who Satoshi is because there don't seem to be any electronic evidence after people looking for 15 years. And of course, if you take sort of speculation, you can speculate, the pros and cons of any one of dozens and dozens of early contributors or electronic cash interested people from like pre-Bitcoin. So I don't think there's anything conclusive there. And, the people they identified obviously denied strongly that they were Satoshi. So.
Makes total sense. Total sense. Well, guys, we have an exciting topic today. The hash rate as a commodity. It's truly a trend that is continuing to evolve in the industry. And I want to kick it off. Really, Matt, you were one of the early people to talk about, hash rate derivatives, hash rate as a financial product. So can you walk us through, what are those financial products really? What does it mean for hash rate to be a commodity, and what can you build with it?
You're not going to ask me if I'm Satoshi first?
Well, go ahead. Are you?
No.
There you go.
I'm definitely not. So good question. So I actually come from a commodity background. So I used to be an oil and gas trader, then traded agriculture products for a number of years. And usually when I talk to people about, hash rate as a commodity, I kind of do analogies on those markets. So if you're a corn farmer, you have all these risk exposures that you have to manage, right? You have, weather you got to worry about, the price of seeds, your farming equipment. But there's derivatives that have existed for a very long time. Actually, it's kind of topical. We're in Amsterdam. The forward derivative market was born here in the 17th century. And it was all based out of a need to have an instrument to basically protect your risk. And so when Luxor hired me 2.5 years ago, they had this, actually the industry had this topic of there's a gap in the market for miners to be able to hedge out some of their risk exposures, namely around the revenue that they get from hash rate. And so, when I was hired, we basically what kind of instrument should we build for this? And to be honest, it's not like we're geniuses or anything. We just basically copy-pasted from other commodity markets. And so, we built forward markets where miners can basically hedge out the revenue that they can expect from their hash rate on a petahash level. Now, it's easy to say, we just built that, but the truth is, you have to educate people. Miners aren't historically, they don't come from financial derivatives backgrounds. So education was key, building the markets, finding buyers of this as well. It's not just miners that are participants. You have to figure out who else wants exposure to these. And so, going back to your question about hash rate as a commodity, we view Bitcoin as a commodity, we view hash rate as a commodity, and there's risk exposures that come with that. And so that's how these markets have developed.
Yeah, and so I kind of want to stop you on that point because we have buyers in the market, we have sellers in the market. When someone buys and sells a hash rate derivative, Sadiq, what are they buying? What are they actually longing or shorting?
So if you look at the composite components of what goes into the hash rate derivatives, you've got things like network hash rate being one of them. So you could say that you're hedging against changes in network difficulty would be the most obvious one that you could say.
And so, Adam, could you explain, if I wanted to go long the difficulty, then what sort of risks am I taking on? What are the considerations around, doing that sort of move or doing that sort of trade?
Well, sometimes there won't be a natural buyer for something, it's hard to get people to sell you a 3-year Bitcoin call option because nobody wants to sell it, for example. So all of the contracts are maximum 12 months typically. And of course, it's very interesting in the commodity space that was just mentioned that there are speculators and there are people doing it, farmers or people growing things, building things who want to hedge the risk because it exposes them. If there's a cyclical market, it exposes their business. So that's a kind of very positive type of financialization because you match speculators who are, sophisticated investors trying to get a return from a volatility situation where people have a real business need to hedge themselves. So, you could say there's something like that going on with mining. I think historically miners have been kind of Bitcoin permabulls. So, they just want to keep all the Bitcoin. Now, in the last few years, there were risks that materialized to do with power prices. And of course, the market itself is very cyclical. So if you're mining, you've got the cost of the miners, which also varies greatly, and the cost of hosting, and the power. So I think that the interesting development in the last few years has been this new concept of the hash price, which is just a standardized way to express the profitability of mining. Because unlike other industries, the Bitcoin is fungible. So Bitcoin that one company mined or one individual mined is completely interchangeable. So you can sort of have a standardized value for it. And the hash price is just the dollars per day that a petahash of mining produces. And it's running quite low now, about $40 to $45 per petahash per day, which is almost a floor price in the sense that I think, if mining profitability dropped, some miners would turn off, which would support that price floor, right? So I think if you're looking at buying these mining contracts as an investment, it's actually an interesting entry point, either via the side contracts that Luxor has, where there's, somebody betting synthetically long or short, or a physical product. So Blockstream has a mining note, which is the first one matured July this year. It was a 3-year product, and so we've rolled it forward, and now we have a 4-year product to match the Bitcoin cycle. And that's like the hash price, right? It's a 1 petahash 4-year contract, and based on the brokered hash rate contracts, usually they're priced relative to the duration times the current hash price, maybe adjusted up or down a bit based on people's expectation about what Bitcoin price and hash rate might do during the immediate future.
Yeah, so that's a very sophisticated concept, right? We're building kind of the frontier of what these financial products will look like. Maybe, Matt, could you dumb it down for someone like me who's not mining, who is looking at this new kind of world of financial products coming together and wants to understand what it means to get exposure to that versus to even just the Bitcoin price inherently?
Yeah, that's a really good question because, like when we built this product, we had miners in mind. Like we wanted to give them a tool to hedge. But, I often get asked the question is like, who's on the other side of this? So if you're using it as a hedging instrument, you're a seller in these markets. You're locking in a price for a given amount of time and hash rate. But on the buy side, what you have are people that are, getting synthetic exposure to mining. So they don't have to have the machines, they don't have to have the data center, they don't have to worry about power costs. They can literally come in and say, I have a viewpoint on hash price. And there's multiple components that go into hash price, right? So you have Bitcoin price, you got difficulty, you have transaction fees, which makes it a really unique instrument. So if you have a viewpoint that there's going to be a spike in transaction fees, you can enter our markets in a long position, betting on the upside. If you think there's going to be a positive difficulty adjustment coming up that's going to affect hash price, you can short it. So, in any robust market, you're going to have hedgers, you're going to have speculators, you're going to have, a diverse set of participants. And to your question, I think, we've strongly encouraged people to come into this space. This is a good entry point for you to get into mining without, all the headaches of actually mining.
Makes total sense. Well, so Sadiq, inherent in kind of these new markets is a lot of risk. And we were touching on it earlier. I know KPMG is working on really quantifying and explaining some of those risks, especially. Could you talk more to that aspect of the market?
Yeah, sure. So we approached this piece of research from the point of view as to how Bitcoin miners would approach risk management. And what we found was that there's essentially three core components that they have to look to. On the input side, it's the cost of energy, and the fluctuations in that are going to create big risks for the miners. On the treasury side, it's what they're doing with Bitcoin on balance, and on the output side is how they're selling hash rate derivatives. So the thesis we've landed on is that if you structure your power purchase agreements in a specific way to optimize your energy usage, and then you use various BTC options, such as calls, puts, perpetuals, you can manage your treasury risk. And then finally, as Matt just said, if you use hash rate derivatives to lock your revenue in, you can essentially smooth the financial throughput through your entire system, and you minimize your downside risk. Obviously, this comes with the curtailing of your upside. You give away some of that potential upside, but you significantly manage your downside. And that's kind of where we've landed with the piece of work we've done in this space.
Amazing. No, that makes total sense. I'm curious then, one of the themes of this conference, right, is really looking to the future. And so to really kind of put the idea of this financialization of mining, this hash rate commoditization, on the spectrum of 2050, in 30 years from now, what do these markets look like? Who are the players? And, is this something that you see growing alongside the Bitcoin mining industry? Does it stay in its own kind of pocket with just people trying to hedge risk? Adam, maybe you want to start, and Matt would love to hear your thoughts too.
Yeah, I mean, I think it's fairly early days for the financialization still. So when we started the mining node that I mentioned, that was in 2021. And since then already, Luxor has new derivatives markets that didn't exist back then, right? So they're actually side contracts. The BMN was also a market instrument, but it's a physical instrument. So, and I think, those markets are not, heavily used yet, or, there's not liquid enough. Things are improving though, because the existence of different markets gives you liquidity so that people can arbitrage between sort of related products. And you need that liquidity so that, if you're going to buy a hedge, you need to be able to sell it and you need to be able to cash it in.
Sorry to interrupt real quick, but I'm just curious. You say the market's not liquid enough right now. Is that just an education issue? Do you think that that's also, is there not enough arbitrage available in these contracts right now? What's keeping it from being more liquid?
Well, I mean, for example, with the BMN1, which ran from 2021 to July this year, some of these derivatives markets weren't there, and many of the buyers were buying with Bitcoin. And there seems to be a price dislocation between what Bitcoin buyers are willing to pay for a hash rate contract, basically, and what US dollar buyers would pay. So that sort of discrepancy, I think, was down to the Bitcoin buyers not caring about the call option. And there was probably $100,000 worth of call option per unit that they just didn't, put option rather, like a hedge, right? And they didn't value it because they're looking at it from a Bitcoin perspective. So I think that ultimately was why the institutional hosters were willing to pay more for infrastructure, to rent hosting space from us than the Bitcoin buyers. And in a normal situation with enough financial instruments, there's a lot of profit in there, right? You've got a price dislocation, and it was just very difficult to arbitrage. So I think, as the BMN2 is coming, and there are now more contracts, the physical hosting contracts are stretching out to 12 months instead of 6 months. It becomes a bit easier to arbitrage that, and that arbitrage itself will add liquidity to the market. So I think if you've got more liquid market, people will participate because they can feel they can rely on it more.
The old liquidity begets liquidity. Matt, I want you to jump in.
Yeah, thank you. Well, I do agree with a lot of what Adam said, particularly the fact that it's early days. Markets take a long time to develop. I was part of the team that launched Bitcoin futures in 2017, and that wasn't liquid overnight. It takes, a diversity of participants. It takes the evolution of the market. I do somewhat disagree. I do think there is a decent amount of liquidity already, though. Like, when we first launched our product, we went out like 1 month in duration, and the best we could do was like 10 petahash. So we weren't really helping anyone. But over the months, we went from 1 month to 3 month duration to 6 months to 12 months, and we went from 10 petahash to 100 petahash to an exahash, and now we're in several exahash. So and this is in the span of a year and a half. So it's growing rapidly. You have to get the institutional players onboarded, and we spent a lot of time getting the publicly traded miners on there to provide liquidity, onboarding market makers. But I totally agree with Adam. You can't just have one market. And I've always encouraged, we get competitors all the time, but we like to help those competitors grow their markets because liquidity does, breed liquidity. And if you have an opportunity for arbitrage, it's going to bring in more people. And so, I think if you flash forward a year from now or 2 years from now, these are just going to continue to grow and be more liquid. Right now, a miner could probably, we clear 5 petahash a month, or I'm sorry, 5 exahash a month, which is still less than 1% of the network, but that's the curve of that is very steep, and it just continues to grow.
Is there a theoretical limit on that? Could it exceed ever the total hash rate of the network that's kind of represented by derivative contracts?
Yeah, absolutely. But it's because it's synthetic, right? So our main contract is cash settled or Bitcoin settled. On a physical contract, no, you couldn't. But on a synthetic, you absolutely could.
I mean, I think the brokering that Luxor does to enable miners to sell, 1 month to 6 months to now 12-month hash rate contracts is interesting because when mining is not very profitable, it's a way for them to sell the downside risk, which helps them get through a bear market without, running into difficulty. And, for a buyer, it's a cheap hash rate contract because the market is low. So I think that's already serving a function to people doing physical things. And our contract is just a longer one. The mining node is a 4-year instead of a 6-month or a 12-month, but they're basically similar concepts. So they're already helping the mining industry to hedge themselves in different market conditions.
Absolutely, that makes sense. So, do you want to jump in on that specifically, Sadiq?
Just to follow on with that, I think we saw the upside example of that as well around the halving. There was so much anticipation around what was going to happen with the halving and the launch of runes, for example. You saw what happened with hash price around that time. And miners made really prudent decisions to lock in their futures and generate revenue. As the block space demand has subsided, we've seen hash price return back to long-term averages. So yeah, they took the upside as well.
Who was on the other side of that trade specifically? Was it just people speculating that transaction fees were to continue to go up, or do we have a specific market participant type that we saw taking that trade?
I mean, in terms of the hash price contracts that miners will sell in a market where the hash price is low, it's, I looked at potentially buying some personally because it's, it's a way to lock in a price, and maybe you can negotiate to pay in installments over 6 months. And then you've locked in today's price, and you're getting it will be close to the hash price, but a buy now, pay later phenomena where you're not paying an interest rate or, a premium like you would with a perpetual future or a CME future, right? So it's a similar product to that in a way, right? Because, you are buying Bitcoin at today's price and paying later in a way.
Yeah, I was just going to say, at least in our product, leading up to the halving, there's the not so secret ordinal launches that were going to come, and people were, acutely aware that there were going to be large spikes in transaction fees affecting hash price. So we definitely had people coming in trying to be buyers in anticipation of that. The problem with those is, they weren't sustainable, right? You have short-term spikes that, if you're on a month contract, that spike isn't super important. But, I guess post having that one was because it was so massive. But generally speaking, we have had a fair amount of people come in, but it makes more sense on a shorter duration.
Makes sense. So we got about 5 minutes left. I want to take a chance to really point us towards a little bit of the broader future, right? There's a few trends that you're seeing in the mining space right now between like AI taking up a lot of energy, co-locating in facilities, this hash rate financialization continuing to grow. Project out, let's say Bitcoin mining 20x's from here. What does this market look like? How big is it, and how much does it affect, the general financial world? Maybe you can start, Sadiq, and then let's go down the line.
So I think we're going to see much more convergence with HPC and Bitcoin mining, specifically because the power consumption of HPC is just so high that they're just going to build bigger and bigger power facilities just to keep power in their workloads. What I think will ultimately happen is as people start to look at the curtailment profiles of HPC environments versus Bitcoin mining, a natural synergy will start to come into play. So whether the HPC clusters are running in inference mode or the AI models are running in inference mode versus training mode has an impact on how energy is consumed. And then if something is running in inference mode where it's naturally very spiky, this is where Bitcoin miners will step in and act as that load balancer for the energy that they produce. That's my personal opinion. I think if you look at some of the trends in the cloud hyperscaler space right now, where some of the big hyperscalers are starting to look at energy installations and are buying up big facilities. So I know Microsoft, for one, recently they're looking into big nuclear facilities to power their data centers. I think that's just a trend that's going to keep going further and further.
Yeah, I think the financialization, it means that more people can participate. If you look at physical gold, you can buy gold mining stocks, or you can buy physical gold, or you can buy a gold ETF, but you can't really kind of participate in a pro rata sense in raw gold mining, right? Whereas with Bitcoin you can, and so that was one of the reasons we thought that the Blockstream mining node was an interesting product, because it provides you with a tradable, like fungible tradable security token that gives you direct participation, right? So you're not buying shares in a mining stock where you're dependent on their management decisions, you're dependent on, how many Bitcoin reserves, how much leverage they have. You've just bought like a defined thing, which is a certain amount of hash rate for a certain duration, and the payout is you get the Bitcoin at term, right? And in the meantime, you can also still trade it. So it's a kind of, financialization or securitization. So it's also literally a security, right? So it's a licensed European regulated security with an ISIN. It means you could even give it to a broker. So the ETFs are bringing Bitcoin into a brokerage trading account, right? And so these kinds of securitized mining contracts that are tradable and standardized. So it's a 1 petahash 4-year contract that you can trade during its term, and it's very easy to look at its kind of price against the hash price graphs, right? So, and I think it's actually an interesting time to buy hash price related products, because I think the hash price is approximately at a floor, in a sense that I don't think they can really fall that much further, because if they do, profitability forces other miners to turn off, and then that will push the hash price back up. And so if you look at it over a 4 or 5 year period, you can see that it's basically some kind of floor level. So even as a dollar basis investment is pretty interesting. The hash price average is a lot higher, 2 or 3 times higher than now. And it's a Bitcoin correlated upside that you can trade in and out of, right? So, it's some kind of reduced downside kind of way to participate in Bitcoin.
Yeah, I definitely agree with everything Adam said. I think, if you're flash forward 10, 20 years from now, I mean, all you got to do is look at other, commodity instruments that exist and how they've evolved over time. Like right now, there's maybe 4 different, financial derivative products you can trade around hash rate. Like you could go into perps, you can go into, futures, options. There's lots of different ways this can evolve. To me, I really like what Adam said around, what makes it interesting is this dynamic between what your hash cost is and what hash price is, right? Because that defines miner profitability. And so, we've seen this before where you get near all-time lows in hash price and get a bounce above it just due to the dynamics that he outlined. So in order for this to be a healthy market, I think volatility is key. And I think, volatility and liquidity would definitely be what I think is important to see in this space as it grows and matures as a commodity.
If it's volatile, it may not show up in someone's retirement account, right?
Well, I don't know. I mean, if you look at it, natural gas is probably the most volatile commodity out there, and next is hash price, So it's it still might be in your portfolio. It depends on what your risk appetite is.
Makes sense. Well, we're just about at time. Any final words before we wrap?
Just a quick one from me. Some of the talking points I've mentioned today are about to be released by KPMG as a piece on risk management in Bitcoin mining. We look specifically at some of the strategies that miners might want to consider in terms of how they manage risk. We're also looking into, in the future, what role the ETFs will play in that, specifically tax issues and tax implications for miners as they move from ETF and spot and backwards and forwards. So, yeah, keep a lookout for those. They should be going live very soon.
Yeah, I mean, I think very briefly that in the last kind of cycle of mining, for the last 3 years, there was an interesting event where China banned Bitcoin, and that gave anybody with a mining position or with some hash rate that they had physically or rented an upside. And if you look at, the current market conditions, of course, the starting point is low, which is good if you're buying, but you want to look at the potential things that could be risks or success factors for the future. I think, probably China can't ban Bitcoin mining again, but the AI and HPC guys pose a risk to expanding the hash rate, which is they're buying up all the ASIC capacity from TSMC and so on. So, once the Bitcoin price increases and there's pressure to put more miners online, people might not be able to buy them, which will put people who are in a position in a profitable situation if that happens.
I'm getting the pleased wrap up, so I'm just going to say one thing. You mentioned education. I think education is key in this space. In order for it to fully mature, all the miners that are in the audience, I urge you to educate yourself, not just on my derivatives, but anything that exists out there, because they're designed to be tools to help you. And anyone that wants exposure, educate yourself, because these tools exist for that as well.
Amazing. Please give it up for this amazing panel. These guys are awesome. Geniuses. Come see him if you want more questions. Thank you, guys.
Live desk, coming live from you from Bitcoin Amsterdam. I'm joined on the live desk by Alan Helm on my far left, or right for the viewers at home, who's the head of product at Bitcoin for Corporations, and right next to me, Zach Bradford, the CEO of CleanSpark. Zach, we're talking about mining. You are one of the biggest miners in the world. Maybe for the people that don't know, can you explain what CleanSpark is exactly?
Yeah, absolutely. It's been a great conference, by the way. So CleanSpark, we are publicly traded. We are on NASDAQ in the U.S. We are on our way to 30 exahash this month, and we expect to add 7 more before the end of the year, on our way to 50 into next year. So we also own and operate all of our mines ourselves. We think that's really important to have control over what you mine and control of the hash rate. That's what we've always focused on, is our operational excellence. And we expect a really great year ahead. So really excited about the content here at the conference. It's been really great. Amsterdam is always really awesome.
Okay, and so you mentioned you own all the hardware. Where do you source your energy from?
We are grid connected, so what we focus on is being that good partner to the grid. Bitcoin miners are the most flexible load, so we participate in the open market where we buy and operate. So we operate actually in 4 states right now in the U.S. So we're in Georgia, we're in Tennessee, we're in Mississippi. We have some exposure in New York, and we just moved to Wyoming. So we're really excited about the growth we have ahead.
Yeah, your slogan, or at least on your website, it says American's Bitcoin miner. When Europe? Why are you not mining in Europe?
You know, we'd love to come here. It's a little bit hard right now with regulations and power prices, so we are focusing. I do think that there's probably international expansion, on the horizon at some point in the future. We will just have to see where that lands. So, but right now we are fully focused on what we're doing in the U.S.
Okay, and Alan, so we earlier saw the announcement of Bitcoin for corporations. As a very short TLDR, can you remind our listeners, viewers, what this means exactly?
Yeah, so quick TLDR, it's an initiative to spread the word of Bitcoin beyond just, as a pleb buy Bitcoin, but on a corporate bounce.
Alan,
strategy.
I got to cut you off. We're going back to the main stage.
Is your company ready for the next evolution in financial strategy? Bitcoin for Corporations is your partner in securing the future of your business. With exclusive membership benefits, our comprehensive masterclass, and a network of trusted service providers, we provide the insights and resources to help you incorporate Bitcoin into your financial strategy, ensuring stability and long-term value. Strengthen your business. Innovate with confidence. Bitcoin for Corporations, protecting your treasury and positioning you for the future.